Two traders traded the same trading strategy, but one had only 2 winning trades and 7 losing trades and made $660 for that week. But the other one had 4 winning trades and only 1 losing trade and made $2,860. And I'm going to show you the difference between it and also how you can improve your trading by seeing better in what direction the market is going at. So we're first going to look at the hard part. That is, you can see here the trader started his trading. He was drawing in, assuming the market is going down. You see here from structure, this is something what's very important. The market likes to go to bigger structure highs and lows. And when we look here at the very, very bigger structure, you can see here bigger structure lows down here, goes up like that, right? Here we have here this low here, we have this low here. And now seeing if the market is making it to this bigger structure low, then going to this bigger structure high, right? So this is what the trading strategy is based. So what happened is that the trader, you can see here very obviously that the market was going down here and then was going up. You can see here how the trader had a losing trade and it could have been prevented. And then afterwards it was going up, aiming for this bigger structure high here. The market is always aiming for the bigger structure high and the bigger structure low. And you can prevent this losing trade that you see here by seeing that the market here where my mouse is has already touched the blue line. And once that happens, you want to see that the market continues to push further down. What happened here is that the market made 3 green candles, a retracement in length that was almost exactly the same here as you can see here from before and also here. So it's just an average movement. It's not that good to trade. That means every time the market goes to a bigger structure high or to a bigger structure low, for example, even here, for example, you want to see that the market has more pressure than usual up or down. For example, when you see that the market does this retracement in average and here, you want to see that here the market does smaller and smaller retracements. And that just didn't happen down there. What is the main reason why the trader here had a losing trade that could have been prevented? The other trader now who had plenty of winning trades, like 4 winning trades, 1 losing trade and made a couple of thousands more that week, is that you see here how the trader was starting his trading. He said very obviously he's going to trade here for an hour. He sees the market that doesn't move up here, assumes the market does around the same move. It makes for him more sense that the market likes to go here to this bigger structure high here than to this bigger structure low. Very obviously with the drawing. Here you can see what actually happened. You can see here the market was really pushing up. And now picture number 3 is we are literally zooming in and you can see here how we adjusted $100 to get a, I don't know, I can't see it here too much, but it's like a $700, $800 trade here with this single trade. Because if we adjust just within a green candle here, $100, right? That's 70, for example, pixels, it says here. It's up here like 7 times, 8 times more of the amount when it comes to length. So adjusted $100 down here would have been up here like $700, $800 for a single winning trade. Aiming for the bigger structure high, what you can see here marked by using here just a thin green line. So now here's the thing. I will show you one more example and then I'll show you this one on the chart, how you can do this also and how you can identify that. Here you can see the market was going to a low, or he assumes that the market goes here to this low. And then when not seeing that the market goes below it, assuming the market goes up here. That's exactly the same day, by the way. Now check out what happened. The market was only spiking with only one wick is what you can see here, only one candle here. One spike down there, goes up. There's up here more candles than down here, and that means the market likes higher prices. And now in the third picture and the last picture, you can see here how the trader literally first made a trade down here. Very dangerous. I don't like this kind of trade, but up here, letting the market going up for 20-30 minutes around, and then here adjusting $100 to make a $700, $800 trade again, aiming not even for the biggest structure high, just a smaller structure high, as you can see here, with a very nice success trade. So we're going first at all to use TradingView. And when you use TradingView, make sure we first go to a 1-minute chart and the S&P 500 ES1 exclamation mark. And this market stays for 30 minutes up to 5 hours either in one price area, what happens here right now, or just goes in one direction, what you can see from down here to up here, right? Like how it goes up here, or more beautiful how you can see it up here. It's literally not just staying for hours, several hours in one price area. You can see up here, it literally shifts up, what is very nice to trade also here, for example. So every time we see that the market is too much consolidating, it's not that good. We first start in the 30 minutes now chart. So when using a 1-minute chart, the awesome thing is we can adjust $100 to make $500 an average. But when going into a 30-minute chart, it's easier for you first to understand what a high and a low is and to see what the market is doing. So I will first do a drawing, and then afterwards I'm going to show this to you on the chart. So we have a high and we have a low. The definition is just to see the spikes. And a high can also be a green and a red candle out of smaller structure, and a red and a green candle is a low. So now you have the definition of a low and a high can either be a spike or a color switch. If the market doesn't have too much enough pressure and it stays like this, then we can't assume that the market goes in any direction. But if the market is not doing that, and you can see less candles, then we can assume if the market doesn't go above here out, then it wants to go down here out and figure out if it can go lower here. If it cannot go lower of there, it comes up, for example, produces a couple of candles. Now we can assume either it wants to go here to this fully high here, to the high again, or because the market couldn't reach it before and go above out, just that the market goes up here to smaller structures highs, or maybe we have here smaller structure highs, right? So we have very bigger structure highs, very, very big ones, and we have smaller ones and more smaller ones. Okay, so I'm going to show this one to you. Let's just start anywhere here, for example, down here. So what I see here right now is I see this one here. So we have here high and we have here low. Check this out. We take a horizontal line, and you can see here now how the market goes from here, has this low. Check this out. Goes up, tries to go above this high, cannot make it, comes back in, and now goes to this low. Cannot go under this low, as you can see here, comes back in, and now check this out. It first wants to go to smaller structure highs, what I was just drawing in, as you can see here. And then because it cannot go above here, you can see now it wants to go to the smaller structure low, but it cannot reach here the medium or the very biggest structure low. And then it goes, check this out here, to the medium structure high. And then it goes to the very biggest structure high. So it's more like a ping pong game. It's like back and forth you need to imagine. So in this case, every time you see that the market has a high, let's just say you have, or a low, we have here this low here, as you can see here, when you make the chart very small, it's from some very bigger structure. And you can see that the market doesn't go below here. Then it makes sense for us that the market now wants to attack here this medium structure high. And if the market, and then once the market touched it, not trading at all here. We want to see how does the market behave here. You can see how the market does a couple of red candles. It's not good to trade. But if the market would look like, let's just say the market would look in this area here, like here, then we can assume that the market wants to go now to this high, and then if that's possible, it's like a domino effect that it wants you to go here to the biggest structure high. I'll show this to you one more time. That means we go here anywhere here. We see here right now very bigger structures in perspective is like here. That means you see here the market is structuring higher. There's a domino effect sort of that the market likes to go to bigger structure highs. That means it makes more sense that the market goes up here than down here. And then again, it makes more sense that the market goes up here than down here. So as you can see here, the market is sometimes also taking smaller lows out, like here, but it couldn't reach this low. And then when you see here, then the market goes up here, is very near to this high. Those are ones of the best trading opportunities. And then once the first candle touched here this high, it's already done. So this is about trading the trend. When you see that the market touched the high, we need to be aware that the market starts to consolidate for 30 minutes or even up to 5 hours before the market starts, as you see here, turning around, and it will have a very hard time here, even going here to a medium structure low here, as you can see here, to get there. So it is very important just to see where did the market went last. That means let's just go here in a 1 minute chart. It works also with very smaller structures, just in bigger structures, it's very obvious. Let's just go here in smaller structure. And then now you can see here, there's this low. Check this out. The market tried to spike here 1, 2, 3 times, 4 times, comes back in. You can see very obviously that the market does up here and up here more candles than down here. So you can see the market does higher, more candles in price. That means here, this is the medium structure high. It makes more sense as of now that the market wants to go up here than that the market wants to go down there. That means every time we trade for a trend, we assume that the market is going to bigger structure highs or lows, and then we aim trading for them. And what is very important as a last note, if you can identify higher lows, if you understand how that works, that means you have your red and a green candle as a low, a green and a red candle as a high. Lower highs when the market is going lower. But if you have red, green, check this out. Red, green goes higher, goes higher, goes higher 3 times, 4 times. And just because of here and there, you can see it was going a bit lower in, there's a one that was higher, and that's why it was like a lower low. And you can see from here to there, there's a lower low. It doesn't matter too much because you can see here 1, 2, 3, 4, 5 times that it goes higher. Now check this out. Even from here to there, ignoring this lower low here, you can still see the structure's higher. So right now we're in an uptrend. And if there's now a color switch in a 1 minute chart, look, in 20 candles, in 20 seconds, 15 seconds, we have a green candle that closes. Entries here, stop placement is there. We need to make sure 2 seconds before this candle is closing, if it's green, and you would adjust here $100, it would be until here $500 with a winning trade. But very important is that we have here a green candle. And of course, we don't have too many red candles as you see here. That means when the market goes up, check this out, it should do only 1, 2, or 3 red candles in a row. And every time you see that the market does 4 red candles, as you see here, this is already where the market is doing a lot of pressure against us. So that means you see it here for once, you see it here a second time that it does 4 red candles against us. And this is where it gets hard. But you can see how the market still, even though if the market does like this retracement and average and move, check this out, from here to here, is from here to here around the same. That means because it is not doing the exact retracement in length, like this would be the exact retracement. But if there's enough pressure, then it should do a bit less movement. And if you have here a higher color switch, this one here, for example, looks kind of good. Adjusting, look, 5 seconds before the green candle closes, adjusting here $100. With the smaller the chart, the smaller the stop placement, what is really, really nice. When here adjusting $100 now, it will be until here $500. And maybe that will be unrealistic because the next bigger structure high will be up here. And once the market is touching here in the market here, very often you will see that the market is just consolidating. So wanting to see more pressures to something, what is very important. Wanting to see also that the market does not 3 or 4 red candles. And if you just look on that, you will have plenty of days, if you just trade for 1 or 2 hours a day, where you will see that the market is doing like 1, 2, or 3 red candles, plenty of green candles, is way more nearer to this high, and then trading to that high. Just try it out on 5 different kind of days using the 1 minute chart. Wish you all love, good trades. JT out.